Okay, this week's topic is multinational capital budgeting. Okay, so the right top, this chapter we discuss how a multinational corporation or business evaluate its project to determine whether the project should be implemented or not. This is called the multinational capital budgeting. Importantly, we will discuss how a typical capital budgeting will be adapted to account for different situations and risk. Our major techniques of evaluation is net present value. All right. So as you remember from the FIN413, capital budgeting is the entire process of analyzing and evaluating different capital projects to determine is like attractiveness, and then to determine whether the company, the corporation, will include this project, individual project, in the company's like future growth plan, expansion plan, right? So we'll this. Okay, good. Now, Cooper, can you go over these objectives?
Sure, can you hear me?
Yeah.
Compare the capital budgeting analysis of an MNC's subsidiary versus its parent. Demonstrate how multinational capital budgeting can be applied to determine whether an international project should be implemented. Show how multinational capital budgeting can be adapted to account for special situations such as alternative exchange rate scenarios or when subsidiary financing is considered. Explain how the risk of international projects can be assessed.
Okay. So in like intro to finance class, I remember, I understand that you talk about just simple domestic capital budgeting process. Now this one is multinational system, right? Multinational framework. So there are several additional factors to be considered in the process. So we'll talk about all those process there. So the basic perspective is the parent versus subsidiary perspective. So we have to consider that. We'll talk about it later, and we have to show like multinational capital budgeting, how multinational capital budgeting can be applied to determine whether an international project should be implemented. That's the goal. That's the goal, right? So, for a corporation, for business to exist and survive and grow in the industry, they have to continue to identify and develop is like profitable capital project, right? So and then include that in the company's like future growth plan, expansion plan. So to do that, they have to know how to like evaluate, how to analyze and evaluate each individual like capital project, and you have to like determine whether that is attractive or not. Okay, and we will show how multinational capital budgeting can be adapted to account for special situations such as alternative exchange rate scenario or when subsidiary financing is considered. So, this is a multinational, like international setting. So, they may be different factors to be included there. So we will try to do that in our like examples, the case study there. Okay. Okay. Now, all right. So why we should consider subsidiary versus parent perspective? There are a couple of important like issues, important factors. Dale?
Kaufman?
Yeah.
All right. Do you want me to read the whole thing?
Yeah, the whole thing.
All right, tax differentials. Different tax rates may make a project feasible from a subsidiary's perspective, but not from a patient's perspective.
All right, let's do it one by one, right? So different tax rate may make a project feasible from a subsidiary perspective, but not from a parent perspective. So you have to look at both sides, subsidiary versus parent perspective. You have to look at those one and analyze and evaluate. Okay, next.
Restrictions on remitted earnings. Government's restrictions on whether earnings must remain in country. Excessive remittances. A project may appear favorable from a parent perspective, but not from a subsidiary's perspective.
All right. So there is the government host government the restrictions on remittance of the subsidiaries earnings. So there's a restriction should be included or considered there, and excessive remittance. Sometimes depending on the remittance, the size of the remittance, the project may appear favorable from a parent perspective, but not from a subsidiary perspective. So you have to pay attention to that and finish that.
Exchange rate movements. Earnings converted to the currency of the parent company will be affected by exchange rate movements.
Yeah, this is a big one, right? So always the earnings and the cash flows in a subsidiary will be in a foreign currency. Now, that foreign currency to foreign currency, that those cash flows in foreign currency should be converted to US dollars, right? And then included in the entire capital budgeting process. So that's the one, additional these factors, important factors in the process of the multinational capital budgeting. Okay. Now, this is generally agreed, conclusion. Dana?
Bachman?
Yeah.
Okay.
Mhm.
Parents' perspective is appropriate when evaluating a project since the parent shareholders are the owners and any project should generate sufficient cash flows to the parent to enhance shareholder wealth. One exception is when the foreign subsidiary is not wholly owned by the parent and the foreign project is partially financed with retained earnings of the parent and of the subsidiary.
Yeah. So generally agreed, conclusion, the perspective is parent perspective is the appropriate perspective when evaluating a project. Since the parent shareholders are the corporate owners, and any project should generate cash flows to the parents to enhance the shareholders' wealth. You remember that the optimal corporate goal is the maximize shareholders' wealth, maximize shareholders value, right? From that. One exception would be for instance, if the foreign subsidiary is not wholly owned by the parent company, and the foreign project is partially financed with the retained earnings of the parent and of the subsidiaries. In this case, that is, you have to take a deeper discussion and analysis there. Okay? But as I said, generally agreed conclusion is the parent perspective should be the right way. Okay. All right. Look at this one. This is graphical illustration of the entire process of the remaining subsidiaries earnings to parents and the multinational capital budgeting that reflect all this flow chart. Okay. First one, cash flows generated by subsidiary. That's the first one. And then the first thing you have to do is to pay the corporate taxes to the foreign government, host government. And then after that, after tax cash flows to subsidiaries. That's the next type of cash flows after tax. And then that one, then subsidiary, they have to decide how much of this, what fraction of this after tax cash flows to be kept in the subsidiary as a retained earnings for the subsidiary, right? After that discussion, after subtracting that like required retained earnings for the subsidiary, the cash flows remitted by subsidiaries. Now, so the remaining will be like the amount, the maximum amount to be remitted to the parents. Okay, but usually host government, they have like they impose taxes on this, this remittance. It's called withholding tax. So you have to pay this one. You have to have this one here, and then after that, that is the after-tax cash flows remitted by subsidiaries to the parents company. Now, up to this point, the cash flows will be in foreign currency. Now, the next step is the conversion of these foreign currencies to the US dollar. So, I mean, the net dollar, US dollar cash flow to the parent company. That's the next step. And then after that, based on these cash flows, we will do that the capital budgeting process there. Based on this cash flows, we will analyze all these cash flows using our capital budgeting techniques and calculate NPVs. NPV approach, that net present value approach, is our major primary approach here. So we'll apply that one. Okay. Input for international capital budgeting. Danny? Danny? Okay.
You want me to read the first one?
Yeah, first and second.
Funds initially invested include whatever is necessary to start the project and additional funds, such as working capital to support the project over time, price and consumer demand. Future demand is usually influenced by economic conditions which are uncertain.
Thank you. So major input to our capital budgeting, international capital budgeting process. The first one is initial investment. So the any funds initially invested should that's include the whatever is necessary to start the project, and additional funds to finance the working capital and others. And price and consumer demand. This one is sales forecasting, based on sales forecasting. So future demand is easily influenced by condition. So based on everything, we have to have projected price and expected demand that will give you our sales revenue. Okay. Dana Lodgman.
The second one?
Yeah, second and third. The cost and tax flow.
Okay. Variable cost forecasts can be developed from comparative costs of the components. Fixed costs can be estimated without an estimate of consumer demand. Tax laws, international tax effects must be determined on any proposed foreign projects.
Yeah. So in the second, price and consumer demand, we projected sales revenue, and then we include the cost, total cost, including your variable cost and fixed. So, and then the last time, the next one is the tax law. So the tax should be reflected to calculate after-tax cash flows. All right. 14. Okay, Gabriel.
Yeah, what would you like me to read?
Yeah.
Remitted funds of the multinational corporation policy from remitting funds to the parent influence estimated cash flows and exchange rates. These movements are often very difficult to forecast.
Remitted funds. After paying tax, the subsidiary they pay taxes, the income tax and withholding taxes on the remittance. So after paying taxes, the remaining portion will be remitted to be sent to the parent company. So remitted funds will be our important input, and exchange rate. Exchange rate, as I said, the cash flows to be remitted are in foreign currency. So to be included in the parent perspective multinational the capital budgeting, you have to convert the cash flows into US dollars. So exchange rate, that should be the important input there. Okay. And then Jacob.
Yep.
Yeah. The salvage value.
Salvage liquidation values. Depends on several factors, including the success of the project and the attitude of the host government toward the project.
Yeah. So, salvage value is the remaining, salvage value of the business operations there, right? That should be at the end of the project life, should be included in our cash flow analysis there, right? Can you just finish the other one?
Required.
Mm-hmm.
Required rate of return. The MNC should first estimate its cost of capital, and then it can derive its required rate of return on a project based on the risk of that project.
All right. This required rate of return is the discount to be used in the capital budgeting, the last stage, to calculate the NPV, net present value. So we in our case study, we will just assume that the required rate of return is calculated by the corporation and then given to us. As you see, there is a separate process of evaluating and determining required rate of return. Okay, and so our case is this one. So the Spartan Incorporation, considering the development of a subsidiary in Singapore that would manufacture and sell tennis rackets locally. Right? So this potential project business operations to be operated in Singapore and in the name of Spartan Incorporation. This is our case study, and then example study. Then we'll do all the analysis and evaluation for the budgeting, capital budgeting. Okay. Jessica, can you read the next one? Spartan Financial Managers.
Yeah. Spartan's financial managers have asked the manufacturing, marketing, and financial departments to provide them with relevant input so they can apply a capital budgeting analysis to this project.
All right. Okay. Let me repeat this one here. Like the profitable capital projects are very important, critical to the company's future. Okay. Companies like growing, the growth, and companies like expansion, The entire process of analyzing the projected cash flows and evaluating the effectiveness of this project operations, that is, as you see, that is called the capital budgeting. It's important and critical for the future of the company, the corporation. So this process itself is a strategic decision. So strategic decision that include all relevant department or relevant like vice president. So manufacturing, marketing, and the personnel, and finance department, all those departments should be like participate in the process. So the VP, manufacturing, VP marketing, VP personnel, VP technology, and VP finance. So the process will be led by finance executive there. Yeah. And can you do one more? Let's go.
In addition, some Spartan executives have met with government officials in Singapore to discuss the proposed subsidiary.
Okay, so to make this happen, you have to work with the Singapore government, the host government. All right, John, finish that.
Capital budgeting analysis is conducted from the parent's perspective, based on the assumption that the subsidiary would be wholly owned by the parent and created to enhance the value of the parent.
Okay, so this specific project, the project life will be 4 years. Okay, 4 years, and then this one, as you see, the subsidiary is the wholly owned by the parents, and then created to enhance the value of the parents. So this subsidiary is like completely owned by the parents and then operated by parents. So the parent perspective is the appropriate perspective and approach for this analysis. Okay, so let me switch to Excel. Go to Excel. So share will be Excel. Do you see the Excel screen?
Yeah, we can.
Yeah, we can see it.
Yeah. So this is the case, multinational capital budgeting and the Spartan Incorporation. As we see, the background is the Spartan that plans to develop a subsidiary in Singapore that would manufacture and sell tennis rackets locally. Now, the input, I know we talk about input, initial investment, price and consumer demand, cost and tax, and a remittance, bond, and exchange rate and salvage value and required rate of return. So all this one, we talk about the input, the major input of the capital budgeting. So let's go step by step. So initial investment is 20 million, that's Singapore dollar. That's since we are going to use the exchange rate of 50 cents per Singapore dollar. This one, it will be like 10 million US dollar, right? 10 million. So initial investment is $10 million. And then price and consumer demand. The year, I told you, the project life is 4 years. No, 4 years. We have so we have 1, 2, 3, 4 years project life. So the first year and second year, the price and the projected price and consumer demand will be 60,000 units are expected to be sold at $350 per unit. The Singapore dollars. The year 3, 100,000 units and 360, and year 4, 100,000 units at the 380 units. That is the price and consumer demand. That will give you our sales revenue, right? Projected sales revenue. And then cost. Cost include the variable cost and fixed cost, right? So variable cost, that's year 1 and 2. The variable cost per unit for variable cost is $200, and year 3, $250. Year 4, $260. Okay, and the fixed cost is $2 million per year plus depreciation, 2 million Singapore dollars. Right. So that is the information about the cost that will give you our total cost. Now, the Singapore, the government income tax is, the corporate income tax is 20% income tax, the flat 20%. Now, another thing is the fund, on the remitting fund, the government will impose 10% withholding tax there. Okay. Exchange rate, we use the best projected exchange rate of 50 cents per Singapore dollar. And salvage of the entire operations will be 12 million Singapore dollar. Required rate of return. Required rate of return is to be used as discount rate of the cash flows, right? Cash flows discount rate. So this one is is based on their cost of the operations and then the risk estimation. So given 15%. So let me explain step by step. Yeah. First, to determine the sales revenue, total revenue, it's just simply demand, the number of units to be sold times the estimated price. So 60,000 times 350, 21 million. And this one, 21 million, the same way. And year 3, we have a slight increase. There's 100,000, 360, 36 million, is 38 million in year 4. Now, variable cost per unit, we have 200, 220, 250, 260. So just multiply by the quantity demanded. This times this one, that gives you 12 million. 12 million. This times this one, that gives you 25 million, 26 million. Now, annual lease expense is 1 million, 1 million. And another fixed annual expense is 1 million, 1 million. Right. And then non-cash expense, that's depreciation. This one is, I think you remember that. This one, depreciation, is not actual non-cash expense, non-cash cost, right? So this one should be readjusted when we calculate the cash flow. Okay, we'll come back to that. Now, as you see, the cost is variable cost, annual lease cost, meaning lease cost means the company, in this case, in this scenario, the company will lease the offices, right? Offices, and they pay 1 million Singapore dollar annually. All right. So total expense is sum of all this expense of 16 million, 29, and 30 million, right? So we have this, the revenue, projected sales revenue minus total expense will be our before tax earnings there. So 21 million, 16 million, we have 5 million, 5 million, 7 million, 8 million. All right, that's the before tax. Now, the government, the corporate income tax is 20%. So 20% of this, before tax earnings. This one will be like 20% is 1 million, 20% of the 5 million, 1 million. So these are tax liability, right? So before tax, there's like EBIT, right? Operating income minus taxes will be after tax earnings of subsidiaries. So 4 million, 4 million, 5.6 million, 6.4 million. So net cash flow to subsidiary there. Now this one is after tax earnings. Now I told you depreciation is non-cash item, non-cash expense. All right. So it's not actual payment or cash out. So when we calculate the after-tax cash flows, net cash flows, you have to add this one to the after-tax earnings subsidiaries. Okay, so we have this 6 million. That's why we have 6 million, 4 million plus depreciation. So 6 million, 6 million, and 7.6 million, 8.4 billion, the Singapore dollar, of course. And we assume that one assumption is, all right, it's not here. But, since this one is the 100% owned by the parent company, the parent company decided to remit 100% of this, the fund to the parent company. So 6 million, the all available net cash flows, the entire amount will be remitted to parent company. So 100%, right? 6 million. Now, this one is the maximum like remittable fund. So the government also imposes the tax on this one is 10%. So 10% of this one is 600,000. So 5.4 million, 5.4 million, and this one 6.84 million and 7.56 million. These are the Singapore dollar remitted after withholding taxes. Okay. Now it shows salvage value returns 10% and exchange rate is 50 cents. Salvage value is 12 million. 12 million. So that's should be accounted at the end of the project life. So 12 million should be included. So total the Singapore dollar remitted after withholding and salvage value is 5.4, this one plus this one, 19.56 million Singapore dollars. Okay. Yeah. Now, the next step is we have to convert that into US dollar. And now here we are given exchange rate of 50 cents per Singapore dollar. So 50 cents there. And then let's calculate that one here. So this one, 5.4 million Singapore dollar times 50 cents. That is $2.7 million. This one is dollar, right? US dollar. So let's copy and paste. That will be projected cash flows to the parent company, okay, in US dollar. Okay. So we successfully calculated the net cash flows to the parent company. That's and the capital budgeting, important step start here. Now, this one that happens over the four-year project life, and then our initial investment by parent is $10 million. So you have to evaluate this cash flows over initial investment by parents and using 15% discount rate. So after we calculating this net cash flows from these operations, the whole operations, including salvage value converted to US dollar, we have to discount this one to using 15% discount rate. Okay, so this is how you do that. This cash flow divided by 1 plus 15%, 15% to the, now this one discounted over 1 year period, because that happens at the end of one. So just enter 1. Okay, you remember that? This is discounting. Okay, we got it. The next one, next cash flow, that happens at the end of year 2. So it should be discounted over 2 year period. So this is what it is. This one divided by 1 plus 15% discount rate to the over 2 year period. You have to enter 2. Okay, that's your cash flow. And then the next cash flow that happens at the end of year 3. So the discount to calculate present value, this is how to discount. This one divided by 1 plus 15% to the over 3 years. So 3 years there. To that. And then the last one is this one divided by 1 plus 15% to the 4 year period. That's the present value. So we calculate this present value. We are successfully converted our cash flow to the present value. Now we can match this one directly. Okay, yeah, directly compare. Net present value. As you see, net present value, it is like initial output plus all cash flow and the present value, the discounted value. You see that? Discounted value, the cash flow divided by 1 plus k to the is. So, to calculate this one here, this is how we calculate. This is how we calculate. Yeah. Okay. Initial investment is 10 million. So minus 10 million plus the sum of all this present value, right? So now, let's say sum of all these cash flows. There is NPV. You see that? There is NPV. That is the definition of it. So NPV, this one is now NPV is $2.2 million, $2.23 million. As you remember, the NPV is one of the major capital budgeting techniques, right? So it's like criteria. Decision criteria is if NPV is greater than 0, the project is profitable. That's a decision rule, decision criteria, right? So in this case, the entire cash flows, the NPV based on all the cash flows, it shows what? Positive NPV, $2.23 million. So we say this project is profitable. Okay. So this is a simple, straightforward process of the capital budgeting. Okay. All right. So this is a simple, straightforward one. Now, as I said, there are several other factors. So all we have to do is to adjust or revise this one to different scenarios or different factors. Okay, let's do that. Let's just step by step. All right, the next one is this one here. The only difference is, we assume in analysis 1, we assume that the exchange rate is like 50 cents, right? In this case, we are looking at two different cases. One is this exchange rate here is quite strong. So quite optimistic case, optimistic scenario. And the other one is weak there, right? So that is a pessimistic scenario. Okay, so we look at usually I include the 3 there because this is optimistic strong, this is weak, and the first one we did, this one is like normal, okay, normal. So I would include 3 cases. We look at 3 different cases, we compare the results. So that is called sensitivity analysis, right? Sensitivity analysis, we'll do that. Look at this one, like as I said, the analysis for 2 different scenarios, here in strong versus weak, yeah. But later on, I'll include that in normal, okay? So everything is the same, everything is the same. The Singapore dollar to be remitted after withholding, including salvage value, is the same thing. As you see, this one is the same thing as the analysis 1. Now, we're looking at 2 different scenarios for exchange rate. So strong optimistic scenario A will be 54 cents in the year 1, 57 year 2, 61 cents in the year 3, and year 4, 65 cents. Now, for this strong optimistic case, we do the same thing. The analysis there, cash flow to parent will be this one, 5.4 million times this exchange rate there. Let's just copy and paste, same process. So this is what? This is our projected cash flows that are converted to US dollars based on this strong projection. Okay, right? And then present value, the same way. This cash flow divided by 1 plus 15% to the 1 over 1 year period. And the next one is this one divided by 1 plus 15% to over 2 year period, the 2. Okay. And this one divided by 1 plus 15% to the over 3 years, so to the 3, the third. And then this one divided by 1 plus 15% to the 4 years. Okay. So we calculate this present value. As you see, the NPV, when you calculate NPV, is what? The initial investment is $10 million, right? 10 million. So based on the other formula, is minus 10 million plus sum of all present value. All present value, this one here. That's it. That's the NPV, right? $4.9 million, right? $4.88 million. That is a net present value under this strong, exchange rate for Singapore dollar scenario. Okay, I said optimistic. Okay, now let's talk about the pessimistic. Pessimistic is, on the same way. So this one cash flow is this one times $5.4 million, right? And then let's copy and paste. Copy and paste. So that is the projected cash flows under this, pessimistic, like weak exchange rate scenario. And let's discount it to calculate the present value. This one divided by 1 plus 15% to the 1. Okay. And this one divided by 1 plus 15% to the second. And this one is, this one divided by 1 plus 15% to the third. And this one is, all right, this one divided by 1 plus 15% to the 4. All right. So we calculate the present value under this pessimistic scenario. the NPV is minus 10 million plus sum of all this present value, discounted cash flow. See, I told you this is a pessimistic. Under this pessimistic scenario, we have negative $18,757. That's it. So based on this strong scenario, it's like highly profitable. Based on this weak scenario, it is not profitable. You see that? We get negative. Okay. Now, I include the strong scenario, weak scenario, and here we have normal scenario. Let's combine all those three in here. Look at this. With this, what do you see? Weak scenario, weak condition, weak exchange rate scenario, we have minus 18,757 NPV. So it like shows not profitable. Under normal condition, 2.23 million. So it's pretty good, pretty profitable. The strong case, $4.88 million is very strong, profitable. You see that? So this is the outcome of sensitivity analysis. You see that? Weak, stable, normal, a strong case. You can see the three different cases and its outcome at the same time. Okay, that's the beauty of the sensitivity analysis. Now, with additional information, like the probability, relative probability for each different scenario, like the 20% chance of weak scenario, 50% chance of the normal scenario, and 30% chance of strong scenario. We can combine the whole thing in one layer, right? Based on this one, you could just get the weighted average. So probability times NPV, weighted average, plus this probability times the NPV, plus this probability times NPV. So if we combine all this one with additional information about the probability for each case, each scenario, then we can combine the whole thing and propose the one like projected NPVs. So what do you see there? We have $2.57 million, right? So our expected NPV, given all this information, right? Given all this information and probability for each case, it is $2.57 million. So our conclusion, based on this one, is this project is quite profitable. So we accept this. Okay. Got it? Now, analysis 3 is the same cash flow, same scenario, but if you look at this analysis 2 here, this cash flow, that is an issue there. I mean, yeah. All these cash flows are in Singapore dollar, right? Singapore dollar. So, as you know, there is an exchange rate risk. Exchange rate, we have no idea what's going to happen to the exchange rate. So the expected exchange rate, we calculated, in this case, we calculated 3 different cases, with different the probability. That's the best we can do. But still these cash flows are subject to uncertainty. You see that? Uncertainty. Now, as you remember, the businesses, multinational corporation, the businesses, they don't like this exchange rate risk. So they try to find some way to eliminate or remove this exchange rate risk. So as you remember, one way, and that process is called, that behavior is called step is called hedging, right? One of the important hedging technique is forward contract. So the corporations, this corporation decide to hedge itself against the exchange rate risk. So hedge part of the cash flows. In this case, a portion of the cash flows, like 4 million, is hedged using a forward contract. See, we heard about this one a lot, right? So a portion of the expected cash flows are hedged at forward rate 48 cents. Right? So hedging forward contract is based on the forward rate 48 cents there. Okay, now, yeah. Up to this point is the same. We calculate all these cash flows, based on this mechanical accounting procedure. So the Singapore dollar remitted after withholding, including salvage value, is 5.4 million, 6.84 million, 19.56 million dollar, right? So that is the same procedure that we did, the same cash flows. Now, as I said, this company wants to do hedge portion of expected cash flows based on the forward rate. So 4 million out of this cash flows, 4 million will be hedged based on the forward rate, which is 48 cents. All right, so hedge cash flow to parent is 4 million. 4 million, that's 4 million, right? 4 million times the forward rate is 0.48. The forward rate is like already determined exchange rate. It is determined by the foreign currency traders, like large financial institutions, banks, right? So it is given 48 cents. So hedged cash flow will be this one, 1.92 million dollar, right? 1.92 million dollar US dollar converted based on. Now the rest here, is 1.4 million, 2.84 million, 15.56 million. This one will be calculated by our best estimate, projected exchange rate, like 50 cents. So the unhedged cash flow will be this one, 1.4 million times our best estimation and projected exchange rate is this one here. So let's copy and paste. So that is our best projected cash flow, unhedged. This is unhedged. This is the hedged. Hedged, that's deterministic. This one's still not 100% deterministic. Yeah. So total cash flow, total projected cash flow is sum of this. Yeah. Copy and paste. Okay. So that is our total cash flows to parents converted to US dollar based on based on the assumption of partial hedging based on forward rate of 48 cents. The rest is the same thing, like normal, like best expected exchange rate. All right. The next step is also present value. Calculate present value by discounting 1 plus 15% to the one. First one. This one, next one is this cash flow divided by 1 plus 15% to the second over 2-year period. And this one is this cash flow divided by 1 plus 15% discount rate to the third over 3 years. And this one divided by 1 plus 15% to the full year. Okay. We calculate all present value. Now our NPV is minus 10 million plus sum of all this present value, discounted value, cash flow. Is there. Okay, it's about $2 million. $2 million. So this is the capital budgeting technique with partial hedging of the cash flow, the remaining cash flows in Singapore dollar. Partial hedging of the $4 million each year based on the forward rate of 40 cents. Still, our conclusion is it's profitable. I mean, an NPV is $2 million. Given calculate $2 million. Right? Analysis says, I mean, the fourth one. This one, there's two assumptions there, right? The background is instead of leasing the subsidiary, the offices with borrowed money, it will use its fund, $5 million, to purchase the offices. Now, as I said in the analysis one, if you look at this one here, one of the item, the expense item is annual lease expenses. Annual lease expenses, 1 million Singapore dollars, right? So that means this one, under this case, the parent company, I mean, the company will lease the offices, subsidiary offices. That's it, and pay the annual lease. But this fourth example, instead of leasing the subsidiary with borrowed money, it will use its own fund, 5 million, to purchase the office. And then after that, after the project life cycle, they will sell them. They will sell them. Okay? Sell them. Right. They will resell the offices. Now, so the difference is initial investment is 20 million, I mean 10 million US dollar, but 20 million Singapore dollar. That was original, that used, right? So 10 million here, 10 million. That's the initial investment. Now this one is 10 million plus 5 million to purchase the offices. So 15 million. You see that? 15 million is included here as initial investment by parent company. That's the one. And the next one is here. So it is after the completing the project over 4-year periods, their salvage value, its initial salvage value was 12 million, right? But after the project completion of the project, they will resell the offices and for the same price. Initial, that's this one. The purchase of offices, 10 million Singapore dollar, that should be added there. The sale of offices. So total salvage value is 22 million. 22 million Singapore. That's the only difference there. That's the only difference. All right. So the others are the same thing. So let's go step by step there. And the first one is, the sales projection. Sales, revenue, projected sales revenue, same thing. Variable cost, 200, 250, 260, same thing. Total variable cost is this unit variable cost times this one, the quantity demanded. So it's 12 million, 25 million, 26 million, same thing. The third one, annual lease expense. Since we purchased the offices, you don't pay 1 million lease expenses, so you put 0, right? And then the other same thing, as I said, 1 million other the fixed annual expenses, and the non-cash expenses 2 million. So the total is, instead of 16 million, we have 15 million, 15 million, 20, 28 million, 29 million. So before tax earnings of subsidiary is this sales revenue minus total expense. It will be 6 million, 6 million, 8 million, 9 million. See that? Now in analysis, the original analysis, it was 5 million, 5 million, 7, 8 million because of the this lease expenses. Okay. Now the last case is 6, 8, 9 million, and then you pay government income tax, corporate income tax 20%, and then this is after tax, and then after tax, to calculate net cash, you have to add this depreciation back. So 4.8 million plus 2 million, 6.8 million, 6.8 million, 8.4, 9.2 million. That is our net cash flow, okay, after tax. So we assume that that the parent company, they decided to remit the whole thing to the parent company, to the headquarters, right? So the whole thing will be paid and will be sent to the parent company, and the government will withholding taxes on this remitted funds 10%. So 10%, 10%, 10%. This is the Singapore dollar remitted after withholding taxes, right? Now, the last one is salvage value. It was $15 million originally, right? But because we purchased offices, and then at the end of year 4, after the project life, we sell the office at the 10 million Singapore dollar. Is salvage value is $22 million. That's the difference. Okay, so add this 2 will give you 30 million, 30.28 million, and this one same thing there. Right? You see the difference, right? Salvage value was million. Now exchange rate is a 50 cents, 50 cents, 50 cents there. Cash flow to parents will be then this cash flow times this our projected exchange rate will be $3 million, and the same thing, this one times this one here, and let's copy and paste. Oops, paste there. We calculate cash flows to parents, projected cash flows to parents in US dollar. Now the next step is to calculate present value, right? This one divided by the same discount rate, 15% to the 1 for 1 period, and then this one is this one divided by plus 15% to the fixed power on the second one over 2-year period, discount over 2-year period. This one divided by 1 plus 15% to the third, and this one is this one divided by 1 plus 15% to the 4th power, right? So this is present value. discounted cash flows or present value over the next 4-year period over its project lives. Okay, now the one difference, another difference, as I said, one difference was this the lease expenses, remove lease expenses and include the this sale of offices, 10 million Singapore dollar, and another change is 5 million. That's initial cash initial investment to purchase the offices. So instead of 10 million, we have $15 million. Now NPV is minus 15 million now, plus sum of all this present value, discounted cash flow, present value, that is NPV under this assumption. Right. Look at this. So under the assumption of purchase the offices at the beginning, that's the additional investment, initial investment, and sell it at the end of the project life, we have NPV of $1.12 million. Still, the conclusion is the same. So the project is profitable. Okay. One more thing. I mean, if you look at the textbook, okay. If you look at the textbook, minus 10 sum of the key number here, key outcome is NPV. $2.23 million is the NPV. But your textbook shows, added some more, right? At the end of year one, what is the NPV accumulated on NPV? So that's the same thing. I mean, that's this one minus initial cash flow is $10 million. 10 million. That way. I mean, and then the previous one plus the cash flow, the present value for year two, and then this one, the previous one, plus this previous present value this way, and the last one is the previous one plus the current present value. So, oops. So dollar, oops, sorry, dollar and oh wow, that is plus. Okay, that is plus. All right. So here, you see that it is like cumulative, each year's annual cumulative NPV. I mean, this one is the first present value and adjusted this way. You got this one is the balance of the NPV for each year. This one. So that is the way of the textbook shows. But this one are not very significant, important. The important figure, important number is this one, the last one. It's called NPV, right? NPV. So it's I mean, to me, it's like a little weird. I mean, I showed all this one. I understand what they are doing, but the key, our focus is NPV, the last figure. And that last figure is the one that we use. Okay, so if you see this one, you don't be confused. This is the meaning, and this one is the most important thing, and this one is calculated. You can calculate this way, or you can calculate right? We can calculate this way, right? Initial investment minus negative plus sum of all present value, that is your NPV. That's your like key number here, and that's the number that the basis number for our conclusion about this, the capital budgeting process. All right? You have any question? So as you see, if you understand the whole process, I mean, it's not that difficult, right? We have the accounting process there, but that's the basis for our analysis for capital budgeting. Once you understand this, NPV approach, it's a matter of applying or revising our the technique to a different cases or different scenarios, like we did. The analysis 2 is like different scenarios. The sensitivity analysis, we did that, and scenario case number 3 is where the corporations, like, they decide to employ the hedging strategy for part of the cash flows, like 4 million Singapore dollar. And the fourth one is the case when the corporation decide to purchase offices instead of the leasing, and then after the project life, they resell them. So because of that, like, initial commitment, your NPV that decreased quite a bit, yeah, but still the conclusion is this project is profitable. All right, I think we covered everything, right? This, the abstract form. If you have any question, let me know, and I think you're ready to enjoy your weekly assignment. Okay. I'll send an email about any announcement or any information. Yes.